All right, good morning, everybody. So it's CPI day. Looking at what the market has done since this bank situation, today really has a lot of impact. It seems the market 100% believes the Fed is done, that that they may raise one more time by 25 basis points, but other than that, they're going to start cutting, and by the end of the year, we'll be moving in the opposite direction with these rate cuts. But that seems short-sighted and wrong. And we're going to know pretty quick. It'll be on March 22nd when the Fed comes out and provides some guidance. Before that, we do have some Fed speakers. We have Bowman this evening. So at the moment, it's not even what the CPI numbers are going to do. As we can see here, they're anticipating a modest decline. If it's not a decline at all, that might spark the market to reevaluate this knee-jerk reaction to the bank situation. It seems like they all just believe that the Fed has tightened the screws until they finally broke something. So now it's broke. So now they're going to quit raising rates and possibly start cutting rates. That's not the situation. We do continue to need to watch Bank of Japan. They are the next threat crisis that needs to be monitored closely. And it's not done by any stretch of the imagination. There's 4 more major reports coming out of Japan that need to be in focus. So a down day in Asia, we nearly have an inside day breakout, but they were able to pull it back and close within the previous day, not by much. So another sideways day here. This is drop base. And from that, we're either going to get drop base rally or drop base drop. I know those may seem like simplistic terms, but they're not mine. They've been around for a long, long time. And we're going to be looking for an expansion candle or a leg candle to come out of this base. Take a look at Europe on that sell-off. 3 days. And even though their day isn't done yet, they're kind of just a really nice indecision candle, really. I mean, that's textbook perfect. So the least we can say is it's sitting inside of yesterday's range. The sell-off, the hard and fast, steep sell-off has kind of paused for a moment. WTI and crude back down near the bottom of that range. They had front run the low last time. This time they didn't, right? So we had a fairly equal low. Then they front run. This time they didn't, but we did have a nice recovery candle yesterday off of those lows. Now we're back down into it again. There's still a lot of liquidity down here. So, think of it like big buyers. So until those big buyers are sated, or until they decide that they don't want to buy at that level anymore, we're just going to keep rising up off of that 72 zone, 73. All of that has been a front run for this 71 area. So even if we were to break lower, there's still an expectation of a large liquidity pool down in this zone. Spot gamma implied move for today, 1%, 5-day move, 2.5%. And we had a really tight range, which we're going to get to it in a moment. Really tight range last night, so a very narrow IB. We do have some auctions today, very close to the front end, like the IRX. It's a 4-week, it's at 11. Other than that, once we're past that, we're really good to go into the end of the day. There's no more Fed speakers this afternoon during the regular trading hours, nobody from Europe or anything like that, and no additional afternoon econ. So once you get past 11, you're basically good to go for like your 0-day plays. So don't get me wrong, CPI is a big deal. We can 100% anticipate that there's going to be a change structure to the market. One thing that's a little bit of a surprise this morning is that the volume is up. Now, this is cumulative volume. It starts at midnight. Generally, if there's nothing in the pre-market econ, will range between 1 and 2. And that's pretty common and normal. But on a day like this, where we have a CPI or PPI or some pre-market economic data point that we're waiting on, we normally see this below 100. The market's not waiting on it. It's trading through it. Now, some of this, again, could still be rolling that's going on because we're coming into a triple witching. And we had the contract change event yesterday. So, some of this volume could still be rolling 100%. But if this CPI data print was so important, they would be standing on the sidelines waiting for it to come out. They wouldn't be trading into it ahead of the print. Now, the Fed had been raising rates because they had runaway inflation. And they said they weren't going to quit doing that until they had proven that they've resolved this problem with inflation. The move in energy that we saw yesterday, that was completely helping them in their mandate, right? It was disinflationary to see crude make that move to the downside. But they don't have any data to point to show that they've tamed this beast or killed this monster. So they can't stop cutting just because a mismanaged bank blew up. I don't have every single detail on the banking situation, but here's what their excuse was. Well, in 2020, the Fed said they were going to keep rates low for a long time. So we took everything we had and threw it into the rates because, well, Powell said so. That's their excuse. So when we say, they were mismanaged, come on, man. Yeah, they were mismanaged. So the Fed's not going to quit raising rates just because a mismanaged bank blew up. And when the market figures this out, they're going to have to start repricing the long end on this rate trajectory with higher for longer again. And the last time the market got ahead of its skis, Powell came out with the Jackson Hole 8-minute mic drop speech where he basically told the market to suck it up and deal with it because it was going to be higher for longer, whether they liked it or not. Looking how everything has been repriced, it seems that he's going to have to pour some cold water on them again, and could be pretty violent. For today, this could be the first glimpse of that wake-up call. If CPI comes in hot, showing that the Fed still has not managed to accomplish their mandate, that might get people to start reconsidering this Fed is done statement. If it does come in a little light, the way it's projected to on Finance Juice, we might actually see a break to the upside. So while I don't like implying that we're going to get big moves without reminding that it doesn't owe us a big move, let's look at some of those numbers and try to come to terms with what we could get today. The average daily range over the last 21 days has been 1.7%. So from the close last night, if we were to take 1.7 and cut it in half, it would be this zone right there. It's half of 1.7 to the upside, half to the downside, and the distance between them is 1.7%. That's the average daily range over the last 21 days. 21 days is a market month. From the close last night or from the open last night, if we moved one direction 1.7%, we would be at this yellow line. And if we moved 1.7 in the other direction, we would be at that yellow line. So I call this the ADR half, and I call this the ADR full. We're looking at 39.63 to 38.30. That's the zone or the range for an average day. Now, I'm not saying that we're going to move that much. Just because that's been the average doesn't mean that it's going to be today's move, right? We're just looking back. Think of your bowling score. If you have a really good bowling score, it doesn't mean that the next time you bowl, you're going to bowl really good. It just means generally you bowl pretty good. So if this is the average move, it doesn't mean we're going to move this. It just means that that's what we've been moving on a day-to-day basis. The next thing that we have today is this market maker move. That's another 2.5%, because I'm going to just round up a little bit. It's a 100-point move. It's another 2.5. Okay. That also is not something that we're going to do today. It's something that we could do today. It's a thing developed by Thinkorswim, a concept focused on the idea that when the front end of the curve is higher than the next series out, they have what they call a market maker move. That's it. So no promise of a move, no guarantee of a move, just a suggestion that we could go 2.5% more than the average daily range. So we want to add this number to that number. Now we could do it two ways. We could take, half of the market maker move and plot it higher. And then we could take the full market maker move and plot it higher and do the same thing lower. We could, but I just want the worst case scenario, right? How bad could it be if we were still maintaining normal discipline? So to do that, we'll just use the drawing tool because it has a built-in measure. We need 2.4. That's pretty darn close, 2.43. This says 2.44, so I'm a little shy. It'll work. It's still underneath the previous week's high, just to, put it into perspective. But it does put us back up into this zone or this range here where we top out around that 40.60. For a downside move, $37.34. So that would be our range for today. Put it out on a daily chart, it kind of looks a little extreme, right? Like, come on, man. Maybe I'm reaching. Just one of that, clickbait, hyperbolic, just trying to excite fear and freak everybody out and get you to click the button. But yeah, no, I don't need to, right? This is all well within the lines of the measured move for today. We haven't even begun to express what an outsized move would look like. This is just a normal move. 40.67 down to 37.34. So if we were to get out of control today, we could expand beyond that even more. Because so far, we've only looked at, that's 3, 4, call it 4.25. Well, 4.25 is nothing. Lock limits start at around 7%, and we've certainly triggered lock limits before. So we have the capacity for a really big move. Just keep in mind, it doesn't owe us a big move, and the market is really, really confused right now about what's going on. They don't know what they should be doing. The fact that they repriced the target rate and drastically changed the 2-year, the curve, the entire curve had a steeper rate of change than we saw during the 07-08 housing crisis. Bigger than any event in the last 20 years. We've seen the 2-year change that much in the last 4 days. That's how extreme and how violent this repricing has been. Why didn't we go up? 2 weeks ago, if someone had said the Fed is going to announce a pause or a pivot and the market's going to start repricing that in, I would have told you we were going to 45. So why didn't we go anywhere? Well, because the Fed didn't say it. The market just believes the Fed is going to have to do it and started pricing it in, but no traders are trading it. There was an expectation that we would buy the rumor and sell the news of the pivot. Where's the buying? Because it's not here. So when we get the CPI today, with the market so confused, we might not really get much of a move out of the market at all from this CPI print. And that's kind of what I wanted to stress. Another thing is it's CPI day. I listened to Bloomberg in the morning, the two grumpy old dudes just, give me a nice chuckle. Most of the morning when they were talking, it wasn't about CPI at all. They didn't care. Like, whatever, it's CPI, but that's not the issue. That's not what they're focused on. So that's a little bit of a concern. If they're not focused on it at all, and it does come in hot, we could see a fairly significant move. Just don't think that it owes us that move today, because it does not owe us a big move. 10-day, 30-minute volume profile, we're underneath the point of control. Any shake to the upside, getting past Monday's high, that 39.65, we're going to run right into that point of control. And while we don't call it resistance, it certainly is a strong level of liquidity, and we would have to get through that zone. I think the more difficult level to get through is going to be right there, right around that 40.11 cog line, because we left that zone so fast. There's very likely trapped traders there. It's fairly shallow, so if we can get through 39.48 or 39.50, should have a straight shot into that POC. We are tangled up into a little bit of this profile, so it's the most difficult that it's going to be. Breaking through our current location and moving up, it gets more shallow, and breaking through our own Globex low, it gets more shallow. So we're kind of in the thick of it this morning. And if we can just clear it on either side, it's an easier path. When we're at the high, we expect to go to the low. And when we're at the low, we expect to go to the high. Well, we just came from the low, so we have every expectation that we're going to go back to the high of this box. Not today. This is a 10-day box. Funny thing is, we have the move, the measured move. We could move that far today. We do have a VPOC underneath us, 37.88, and we got one above us at 4,000. We could hit either one of those today, no problem. The expectation is if we do hit one, it will give us a first touch play. All right, so a pullback, a rejection, a counter trend opportunity. They're short duration, but usually high probability. This morning may seem kind of narrow in relation to, say yesterday, but that's not narrow at all. And the volume isn't as light as I would have expected. This is the range for the entire week. It was the expected move that we got last Friday. 39.79 to 37.79. I'm just rounding to make things an easier number. It's a 200-point range. We're above Friday's close, but we're nowhere near the top of the box. And today we could very easily expand outside of the box. No problem. So everything else is going to come down to this. I'm still not seeing Yellen showing up on speaking engagements, which means they're probably going to book her somewhere. It just won't be listed in advance. I have every expectation that we're going to see Yellen out talking while the Fed is in quiet mode. The other thing about that quiet mode is there's still times where they feel that they need to communicate with the market and they can't because they're in that quiet mode. For some reason, this guy, Nick Tamaros, will speak for them through his Twitter account. He will leak things or post things that the Fed wants him to post, like a little puppet. I don't know what makes him special out of all the people out there that they could use to get this done. But that's the account that you definitely want to keep your eye on a day-to-day basis anyways, let alone during a blackout period. Now, believe me, I hate Twitter. I hate Twitter. I don't go there any more than I have to, which is why I built this Discord to monitor Twitter accounts for me so that I don't have to go to Twitter. Keep your eye on this guy. Because if they're going to come out and give any pre-FOMC guidance, it's going to be here. Now, not every single post that he publishes is a representation of the Fed, which makes it a little tricky because sometimes he's speaking for himself and sometimes he's speaking for them. So it kind of sucks from that side of things. But yeah, for the most part, just this is one to it's one to watch. If you don't watch anything else, at least watch that one. All right, so here's the 5-year. I was looking for the 2, but the 5 represents that change fairly well. That's a pretty significant change in 3 days, right? Now, sure, it's backing off a little bit today, and that's something to be aware of, right? Because that backing off could mean that the market's starting to get wise to the idea that the Fed doesn't necessarily have to cut or pause. They could just keep on raising rates at a nice slow pace. Now here's the Japanese 10-year, and they run a yield control system that was set at 0.25%. And then when it got out of control, they set it at 0.5%. And that's where things had been until this situation. And oh boy, did they lose control of that one. Right? It just got completely out of control. But they're moving back in the right direction now. The candle is still red because it opened it down here, which means it opened lower than it closed. but it's hollow because it's ran back up since then. So it's sitting above that 25%, but it's still not near the 0.5%. Now, on a day-to-day basis, I watch KRE and NY Fang. These two have been my staple for a long time now because I want to know what's going on in finance and I want to know what's going on in technology. But the NY Fang isn't technology and KRE is a limited scope on financials. So if you look at the XLF, it has a lot of stuff in it. It's got insurance, it has trading desks, banks, lending institutions, all kinds of stuff is in the XLF. So I don't really watch XLF on a day-to-day basis, but I do watch KRE, and I have for a long time. It's regional banks. And for the NY Fang, sure, it's not technology, but I don't need to look at 70 no-name Joe Schmo crap tech companies. I only need to pay attention to the biggest, most impactful, largest market cap tech companies and consumer discretionary companies that can shake this market, the FANG stocks. And that's what this represents. For risk on and risk off in the market, we've got the 9 grid setup, right? 3 across the top, risk on, 3 midline, and then 3 across the bottom that are risk off. This would be the risk off right here, XLP, XLV, and XLU. And this would be the risk on, XLF, XLK, and XLY. That's finance, technology, and consumer discretionary. Now, finance got whacked as a knee-jerk reaction of sell it all and we'll figure it out later. In fact, a lot of those regional banks are up this morning in the pre-market because the market figured out that a lot of those banks weren't in the same situation. And now their price to book ratio is completely inverted, and that makes them a good buy. At least, you know, if you're a trader focused on fundamentals, it makes them a good buy. The chart technical analysis, on the other hand, maybe not so much. And speaking of technical analysis, there's a reason that we don't do technical analysis on a chart that looks like that. The whole concept of technical analysis is looking at consistent themes and patterns, that there's price action that you can read like the pages of a book. So when the market breaks out of that pattern and makes extreme violent moves, it breaks the system. You can't perform technical analysis on a parabolic market with gaps and big moves like this. There's nothing to perform. So we wouldn't analyze this with a scope towards technical analysis because there's nothing to analyze. We need the pages of a book with words and writing in it. This is just a picture of chaos. So it has to settle down, or using IBD's words, it needs to heal itself because it's damaged. Stockcharts.com speaks that way too. This is a damaged chart and it needs to heal before we could perform technical analysis on it. We are expecting some linear regression, a little bit of mean reversion. If we look at 10 as the mean, then we could at least anticipate a little bit of move back towards the 10. And if you wanted to use like a Linreg line, there's your wave. And at the very least, you could expect to come back towards the white line. So we're oversold completely, 100%. And we are way beyond the normal distance from the 10, even way back here on that October 10 recovery. It wasn't just an XLF, it was the entire market. That intervention where they saved the system, even that distance from the 10 doesn't compare with this distance from the 10. So we got to have a little bit of anticipation that we're going to go back up in the financials, even just for a short term, right? But it doesn't owe us that, right? Because there's no pattern here that says we're going up. Just an overextended market that makes us believe that it's due a bounce. Same thing with KRE. So you can see the swing low, swing high, and then a much more muted swing low and swing high. And now this extreme crazy move. So at the very least, we would expect that it's going to come at least a little bit back towards that 10 and or back to the white line, because it's a little overextended. And mean reversion alone suggests that that's very likely what's going to happen. But there's still a lot of people scared of their bank and scared of their broker, and they're running redemptions. So, the system could start to collapse from that, even though what happened at that bank was just a mismanaged bank. It wasn't even the Fed. All right, so with TLT, we did have this big move back to the upside. 109 shut it down. We're now kind of stuck in this zone or this range. When we came down around $100, it became a real threat, right? And this down day was when I called that flip in the market and said they had to defend this sucker or else. And they did. I mean, we came up, the S&P, the Qs, everything. The market just flipped over and away we went, including the bonds. Yay, great. But now we just hit a major level of resistance. And there's been a number of times in the last few days where I seen the S&P moving in the same direction as the bonds. And then it would change, and it would be the S&P and the yields, and the bonds were going completely the opposite of everything else. So this morning, the 10-year is up a little bit, but it came off fairly strong, right? When we were above 4%, and now we're sitting at 3.39. And someone very much smarter than me continues to point out that a below 3.3 is a deflationary impulse. How's that for some 8 in the morning language, huh? If we see this 10-year get below 3.3, it's going to be a serious situation. So it's a number to keep marked on your chart, right? 3.3. But it's the 2-year that's really rocking it out. And that just made new record moves in the last 4 days. Well, there's the 1-year. So pretty extreme. While the CPI could be impactful to the market, just as a reminder that the Fed isn't done yet, and it could get the market to begin coming to terms with the fact that they may have reacted too quickly to this bank fiasco. I think that's going to be the worst of it, right? So the forecast is 0.4. Previous was 0.5. And if we're looking at core numbers, then they're really looking for the same. And if we're looking for year-over-year numbers, they're looking for, nearly a 0.5 percentage point decline. And if you're looking at core year-over-year, you're looking at 0.1%. But they're still looking at a decline. That's that modest decline that they talked about in the 5 things you need to know email from Bloomberg. A modest decline. But if it's not a decline at all, that might get the market to reconsider this curve reshuffle. Remember 1 week ago, we had a 70% chance that we were getting a 50 basis point rate hike. That's now at 0. That's how fast they repriced that curve. And there's still a 25% chance that we're not going to get anything at all, that they're just going to punt without raising rates. If they start to unwind that and start putting it into the 25, then this number 73 is going to go up closer to 100. And we might start to see a reemergence of this 50, depending on how bad the CPI numbers are today. I really think 50 is off the table. I honestly do. I think 50 is done. But we could see the 75 go closer to 100. This would be another 25 basis point rate hike for May 3. And right now, a continuation of 25 basis points for March and then May, that's still on the table. and then the pause for June, or by June, this is pricing in that the market is going to pause, that we would get to 4.75. No, that's wrong. From 4.5 to 475 in March, 475 to 5 by May, and a pause for June. So yeah, that's where the pause would come in. That's what they're pricing. And if they have to change that, this is very likely where they're going to start trying to change that curve, right? March, it's too close. I don't think that's going to impact the market. May, they're already pricing in 25 basis points. So that's exactly where it needs to be. This one is the one that would have to change. June. What we would see is this would start to decline. A new bar would show up and it would say 500-525. And we would not see these two, maybe even these three. So what you want to be watching for is right there, 5 to 525. You want to see this number start to go up if they're starting to price in higher for longer. See here, they're already pricing in a rate cut by July. We would expect that to go down and maybe this one to go up, or again, a new bar. And it would be that 5 by 5.25. Now, something to consider, since this CPI may be too confusing. See, if it's too muddy, if it's too confusing, the market won't necessarily respond to it too heavily. They'll wait for the analysts. So you'll get some violence, but nothing really extreme. And what that ends up doing is giving us a pre-market peak or a pre-market trough. So here's a pre-market event. Things got violent. It didn't really give any clear signal. The market had to wait on it. So it kind of sold off till we got into the open and then rallied back up, trying to resolve that liquidity issue, and then back down again. We stayed ranged inside of that candle for the most part and through most of the day. That candle became the dominant theme. So what we get at CPI today may control the rest of the day, the structure of the entire day. I mean, sure, we came out of that range, but we couldn't hold it, right? We just kept coming back inside the range again. So this is exactly what could happen today, that it doesn't have to be some big monster move that takes the market for a ride. All right, now here's a different kind of pre-market reaction to CPI, PPI, one of those. So we get the event, the market sets a crazy high, pulls way back and spends the rest of the morning trying to come back down and reset that move. It creates a liquidity vacuum and a gap. I know it doesn't look like a gap because you see candles, but there is a liquidity gap there. So it's spending all of its time and effort coming back down to get that gap closed. And once it got it closed, we basically just chopped into the end of the day at that point. So when it comes to trying to figure out how to play these events, one of the best things you can do is go back and look at old events. As crazy as it sounds, it works, right? I mean, that's the whole idea behind technical analysis. Look at what's happened in the past and realize that even though it won't be a picture perfect thing, it's very likely going to look a lot like it did last time. Here's a move to the downside, same situation. We actually set a peak and a trough. And where did we finish? Right back down at that trough. It tried to make a move back up to where it started, failed to get all the way back up there to close the gap, and down it went again. It just gave up on it. You can Google previous CPI days and FOMC days and all of them, all those events, and you can mark them out on the chart so that you know exactly where they were. Here's another one with a, some kind of economic pre-market event. It set a high, faded off of that, and as we came into the open, what did it do? Ran right back up there, tapped out, and then down we went. So when we get this pre-market print this morning, keep track of where it starts, mark that level. And then how high it goes and how low it goes. That big candle becomes the candle that you want to mark. Marking big candles, whether you're on a 5 minute, a 5 hour, a daily, weekly, monthly, mark the biggest candle out closest to you, and that becomes your dominant candle. That's a little simplistic, but it'll work, right? It doesn't need to be any more complex than that. Keep your eye on the dollar for the bigger picture move. After CPI today, we really want to see, is the dollar breaking below yesterday's low? It'll be the key level we want to focus on, 103.5. Or is it breaking out of yesterday's high, 104.5? Just use a little math to round up, right? Just round it a little. So 103.5, 104.5. If we get below 103.5, we're going to have an expectation of the market trying to reclaim that 40.25 level. If we get above 104.5, we're going to expect the market to break below that 3.850 level. Right now, that's a little bit of, what's that word? A little bit of swag, right? We're kind of eyeballing it. But that's a pretty close level, right? What we would get a year ago is if the dollar moved up, the S&P would move down, and if the dollar moved down, the S&P would move up, and they'd be like a teeter-totter, completely inverse of each other, like a seesaw. But we've disconnected from that. Now it's more about, where is the dollar at? Above a level, below a level, and we want to use that instead. The VIX is waking up a little bit. We did see some of that reaction in the last few days, but it's not enough. So we got into that $30 level and came right back out of it again. Today, watch for the VIX to get below 22 or to get back above say 29 and start getting into that $30 level again. VIX above 29, we should see the S&P, start getting below that 3850 level. VIX below 25, I think we're going to get above 4,000 in the S&P. We're still seeing crude sell off. It did try to recover yesterday, trying to close that gap, and it couldn't quite do it. It just came right back off again. So now it's got two zones that it's really focused on. It's got the low from yesterday, and it's got this intraday high to focus on, 76 and 72, 72.5. So we really want to see how that resolves itself. The impact in crude is going to be a bigger deal. It's way over my head to try to swag any of those levels. I'm not even going to try. But I would say focusing on yesterday's low would be a pretty simple thing to focus on. So if we see crude break down below yesterday's low, that will continue the narrative of disinflation. Remember, the Fed is looking at dot plots that are a lagging tool, and this bank situation is a leading tool. The thing is, I'm going to stick with the argument that this bank didn't blow up because of the Fed raising rates. It blew up because it was mismanaged. And the Fed's going to continue to raise rates until they can prove that inflation is going down. Well, energy would be a part of that argument, that not this month, maybe not even next month, but that the month after that, the data is going to show inflation going down significantly due to things like oil going down, which is disinflationary. It's too far down the road. You got moments, people, before the print comes in, and it looks like they're front running it already. Be safe. Have a good day. I will see you all tomorrow.